Right now, while most people are going about their daily lives, the global financial system is flashing warning signals that haven't been this intense since 2008. You might not feel it yet, but the machinery underneath your savings, your job, and your cost of living is shifting in ways almost nobody is talking about honestly. This isn't about a single bad day on the stock market. This is about a fundamental repricing of everything you've been told is safe, and it's happening in real time while the headlines are busy with noise. Let's make this concrete. In 2022, the S&P 500 dropped roughly 25% from peak to trough. Bond markets, which are supposed to be the boring safe part of your portfolio, suffered their worst year in over a century. The average 30-year mortgage rate in the United States doubled from around 3% to over 7% in barely 12 months. Millions of people who were told to just invest and wait watched six figures of supposed wealth evaporate. And here's the part that should unsettle you. That wasn't a crash. That was a controlled descent. A real bear market doesn't announce itself with a single dramatic day. It erodes confidence slowly, quarter by quarter, until one morning you wake up and realize the financial assumptions you built your life on no longer hold. So what exactly is a bear market? The textbook definition is a decline of 20% or more from recent highs, sustained over time. But that definition is almost useless because it tells you nothing about what it actually feels like. A bear market is a prolonged period where asset prices fall, credit tightens, optimism collapses, and the rules of the game seem to change without warning. It's not just stocks dropping. It's companies freezing hiring. It's your landlord raising rent because their own financing costs just spiked. It's the startup down the street that was valued at $200 million last year quietly shutting its doors. It's your cousin in tech getting laid off with a severance package that used to last 6 months but now barely covers 2. Bear markets are measured in percentages, but they're experienced in canceled plans, sleepless nights, and the slow realization that the easy money era is over. The most dangerous thing about a bear market is the psychological cycle. It starts with denial. People look at their declining portfolio and tell themselves it's temporary, that the market always recovers. And historically, that's true. But the timeline matters enormously. The dot-com crash of 2000 took the Nasdaq down 78%, and the index didn't reclaim its peak for over 15 years. 15 years. If you were 35 when you invested heavily in tech stocks, you were 50 before your money recovered. The 2008 financial crisis took the S&P 500 down 57%, and it took until 2013 to fully recover. These aren't abstract numbers. They represent people who delayed retirement, couldn't fund their kids' education, or were forced to sell at the worst possible moment because they ran out of cash. Here's what the mainstream financial media consistently gets wrong. They treat bear markets as events that happen to the stock market. In reality, bear markets are symptoms of deeper structural shifts. The 2008 bear market wasn't about Lehman Brothers failing. It was about an entire housing and credit system built on fraudulent assumptions finally breaking. The 2020 crash wasn't about COVID alone. It was about decades of corporate debt accumulation, zombie companies kept alive by cheap money, and supply chains optimized for efficiency with zero resilience. When you're inside a bear market, you're not just watching prices fall. You're watching the consequences of years of accumulated imbalances get settled all at once. The current environment carries echoes of multiple historical bear market triggers simultaneously. Global debt sits at roughly 330% of world GDP. Real estate markets in major cities from Toronto to Sydney to Amsterdam are correcting from pandemic-era speculation. The Federal Reserve and other central banks spent nearly 2 decades suppressing interest rates to near zero, and that era is definitively over. When money is expensive, every asset that was priced assuming money would stay cheap gets repriced. That includes stocks, bonds, real estate, private equity, venture capital, and frankly, entire business models that only worked because capital was essentially free. So how do you survive this? First, understand that survival in a bear market is not about picking the bottom or finding the one stock that will bounce back. It's about positioning yourself so that you don't have to sell anything at the worst possible time. That means having a cash reserve that covers 6 to 12 months of expenses, not the 3 months that financial advisors typically recommend during calm periods. It means reducing fixed obligations now, while you still have income, rather than waiting until credit conditions tighten further. It means being brutally honest about which of your investments were based on fundamentals and which were just riding the momentum of a rising tide. Second, recognize that bear markets create the wealth of the next generation. Every major transfer of wealth in modern history happened during a period of economic distress. The families who bought Manhattan real estate after the 1970s fiscal crisis, who invested in Apple and Microsoft during the early 2000s, who picked up San Francisco properties in 2009, didn't do it because they were geniuses. They did it because they had liquidity when everyone else was desperate. The opportunity is real, but only if you've preserved the ability to act. Third, diversify across asset classes and geographies in ways that actually matter. Owning 10 different tech stocks is not diversification. True diversification means holding assets that behave differently under stress, including commodities, inflation-protected securities, and exposure to economies that are not correlated with the United States business cycle. Countries like India, Indonesia, and parts of the Middle East are building economic infrastructure right now that will matter enormously in the next decade. The uncomfortable truth is that most financial advice is designed for bull markets. It assumes rising prices, easy credit, and general optimism. A bear market demands a completely different mindset, one built on patience, liquidity, and the willingness to look foolish while everyone else is panicking. The people who come out of this period strongest will not be the ones who predicted every move. They'll be the ones who simply refused to be forced into selling what they truly believed in. Here's what changes everything once you see it clearly. A bear market is not a disaster. It's a correction of mispriced reality. The disaster is building your life around the assumption that the mispricing will last forever. The people who understand this don't fear the bear. They prepare for it, they endure it, and when the cycle turns, they're the ones holding all the assets everyone else was too scared to buy.